So the authors are studying price momentum across various European countries here. You see all those. And they're looking at the period 1987 through 1999. And this is a 2002 paper. So there's been a lot more that's come out since then, but this is some interesting stuff to learn. At the time, there were a lot of studies that came out about the cause for momentum returns, and one of those being the underreaction to earnings. And so here the authors are going to explore earnings revisions and earnings surprises around the momentum to see, is it actually evidence that momentum might be caused by the underreaction to earnings information. Okay, so here we have the results of their studies, Table 4, and they're looking at, well, first of all, let's explain how they formed the portfolios. They did it in a similar manner to Jagadish and Titman back in, I think, 93, 94, where they split the portfolios into deciles, that's groups of 10, and ranking them according to whatever their return in this formation period. So that would tell us the past returns over that period. And so then they rank them according to how big those past returns are. And we can see here they've got the formation period statistics for each of the deciles. So the stocks in the top decile here had the highest past returns, and the lowest decile, the lowest past returns. And there are two different construction methods here. One of them, which is this panel A, is they construct a new portfolio every month. And so this would mean that at any one time, about 10% of the entire portfolio across all of the deciles is rebalanced. And in panel B, they only rebalance in the reporting months, the earnings reporting months. Anyway, so we can see here these are the returns for each of the deciles and each of the holding periods. And we see there's definitely a monotonic increase as the decile increases, which would say that past winners outperform the past losers, and that seems to be the case across all formation periods. And we see that in both portfolio construction methods. And next we come down to panel C, which provides us with some risk-adjusted returns. And so these are the returns that were made after controlling for company size, the value versus growth factor, the market return, and country risk. So we see here that and only the 7 through 10 deciles would have positive excess returns after controlling for all of the normal risk factors. And we've got pretty much the same result in the construction method of rebalancing in reporting months as well. And then next, the authors split the population into sub-periods. So this is the 87 to 93 and the 93 to 99 period. It looks like we've got the same results as in panel A and B that showed pretty monotonic increase to returns as the decile, that is the level of past returns, increases. So next the authors are looking at the relationship between momentum and other commonly used factors such as the book to market, the value factor, market cap, which is the size factor, and then also expected earnings growth. So what they're trying to do is decide whether these momentum returns that are happening are actually just returns to the value factor, or maybe just returns to the size factor. And so first they look at the book to market, and we see that So if momentum returns were the same as value returns, we would expect as the momentum returns increases, which is from 1 to 10, then we would expect to see the value returns increase as well. But in fact, what we find is that in most cases, periods either 12 months before or during the reporting month or the 1 month after, the 12-month after, in most cases, the relationship between value and momentum decreases. So we can conclude that the returns to value actually decrease as the returns to momentum increase. And we see that that's the case for market cap as well. Here we should have a reversed analogy where smaller and smaller companies should earn higher and higher returns. But actually what we find here is that larger and larger companies earn the higher return, which is opposite to the momentum returns. And so we could say in both these cases, market cap and value are unrelated to the momentum returns. So next, the authors are looking at the expected earnings growth and how it relates to momentum. So the thought is that momentum might occur because of the inefficient incorporation of earnings expectations into securities prices. So therefore, the higher momentum companies should have higher expected earnings growth. But the authors conclude that since the 1 month expected earnings growth variable doesn't increase in line with the momentum increase, then we can reject that hypothesis as well. And so that might mean that analysts typically under or overestimate earnings. And this might point to their delayed reaction to new information. And so next, the authors are looking at earnings surprises. So this would be at the earnings announcement date. How different were the actual earnings compared to what the median estimate was by analysts, and that's scaled by the expectation. So this is an average percentage of how right or how different they were when estimating the earnings. So in the study here, we find that in the top momentum portfolios, that's the ones up here, these are the ones with the highest past returns, there are positive earnings surprises. So that would mean that analysts typically might be too pessimistic about the earnings of these companies, and so they end up being surprised with positive earnings announcements. And then with these lower momentum portfolios, we see that the earnings surprise is actually negative. So maybe analysts are too optimistic about the future earnings in the past loser portfolios. So next we have earnings forecast revisions, and this is in line with what we found with the earnings surprises as well. Only the difference here is that analysts revise their forecasts, not the earnings haven't necessarily come out yet. We find similar results where the higher, more momentum portfolios end up typically having a positive or at least less negative earnings forecast revision than the lower portfolios do. And so this might provide evidence that momentum is caused by the slow incorporation of earnings information into security prices. And so next, the authors looked at what percentage of these earnings forecast revisions were positive compared to all of the revisions. And it turns out that as the level of momentum of the portfolio increases from our first decile to the 10th decile, typically we see that more and more of the earnings forecast revisions are positive as a percentage of all the revisions. And so that's in line with the other panels as evidence that maybe analysts underreact to earnings information, or rather that investors do.